Welcome to this week's Symax Fintech Market Insights. As usual, this is split into 4 parts, just so we look back at last week, forward to next week, macro outlook, and also we do some technical analysis on a variety of asset classes. So we're starting with our disclaimer as usual. So trading does involve the potential loss of risk of capital and is not suitable for everyone. Hopefully it is for you though. And because many companies will provide you with leverage, just be aware you can lose substantially more than that initial investment. Everything that's included in these is just purely for educational purposes. We're not trying to provide you with investment advice or encourage you to trade or invest. That must be your decision. And before you make that decision, of course, carefully consider the risks involved, your financial situation, definitely your level of experience and risk appetite. And of course, only risk capital you're prepared, but more importantly, that you can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before you risk your capital. That's so important. Okay, so let's look at what happened last week. So, yeah, I mean, we had Jackson Hole Symposium, which ended the week with Powell's speech. Stocks had a sort of a up and down week. They was all over the place really, but they did end the week slightly higher. But you know, as I say, there was some volatile swings during last week. One short-lived boost for the stock market was the Nvidia results. Obviously, they came in better than expected. But then on Friday, Powell sort of sent the markets in both directions as traders, investors were trying to work out what's going on and, you know, what's going to happen next, because, you know, that's where we're always looking. We're looking forward. And you know what now it means for interest rates. So commodities struggled a bit, especially with the stronger dollar. And of course, there's concerns on demand. But then we've still got those wage pressures. That's still quite high because obviously there's still that lack of workers. And rents seem to be finally at their peak and starting to drip slightly lower. WTI traded either side of $80. Gold was volatile actually. And of course we saw a stronger dollar. Now, Fed speakers were a little bit mixed on, you know, their expectations. Some still calling for more hikes. Others saying that, you know, it's time to pause and stay sort of just where they are for the moment and let the markets and the economy just absorb what's happened to date with all these continuous rate hikes. So if we look at the data that happened last week, then housing remains weaker. The Richmond Fed Manufacturing Index was down 7. Initial jobless claims were a little bit lower than expected. Those expected around 240, but they came in at 230. Now the PMI, the composite, was lower than expected. It was at 50.4. Manufacturing was lower. I mean, it was expected to come in at 49.3. It came in at 47. And services have started to drop off as well, although in the US they're still sort of in that expansion because they're at 51, but they were expected around 52.2. Durable goods, they came in worse than expected. They were down 5.2%. When they was expected about 4%. And then the Kansas Fed manufacturing came in at 12. Moving on to the EU. So again, sort of a few PMIs out last week. So for in Europe, the composite came in at 47. You know, anything below 50 is contraction. Although, you know, for me, really, I want to see it below 45 to say, well, that's not so good. Uh, and there we are with manufacturing. It was higher than expected, but it still only came in at 43.7. And services was expected at 50.5, but they came in at 48.3. So maybe we're just seeing a little bit of a change in the balance there. You know, maybe we're getting to get that manufacturing just improved slightly, but less demand for the services. And consumer confidence came in at negative 16 when it was due to come in at negative 14.3. Then in Germany, we had the GDP absolutely flat zero quarter on quarter, which left them at negative 0.2 year on year. Then IFO, now the business part of that came in at 85.7. The current came in at 89, and expectations much lower at 82.6. So not too much confidence in the German economy at the moment. Then PPI was negative 1.1% month on month, which was negative 6% year on year. So again, that's sort of useful and helpful towards bringing inflation down. In Germany, PMI composite was much lower than expected. It was, you know, it's due about 48.3, came in at 44.7. And our manufacturing again did improve slightly, 39.1 though, so still very deep in contraction. And services was expected at 51.5, and they came in at 47. So again, you know, we're seeing that sort of reduction in demand for services at the moment as well, and you know that they are sort of quite high. So yeah, so it's all going into contraction. In the UK, public sector borrowing was much lower than it was expected, so it only came in at £3.48 billion. PMI composite, so again below 50, so it was 47.9. Manufacturing 42.5, that was expected at 45. And services came in at 48.7 when they were due 50.8. So again, you know, disappointing with the majority of the PMIs everywhere. Then in New Zealand, retail sales came in down 1%. That was better than what was expected. Australia, we saw PMI composites again, so 47.1 with manufacturing at 49.4, which is not too bad. But their services is lower than their manufacturing, that's at 46.7. But they were both lower than expected. In Japan, their PMIs, manufacturing came in at 49.7. Services at 54.3, so that's pretty good. CPI was 4% year on year. That's the core CPI. Canada retail sales came in just above par at 0.1% month on month, but they are down 0.8% when you exclude the autos. And then finally, China. They did trim rates, but less than expected. They only did a 10 basis points cut to 3.45%, when general expectations was it was going to be 15 basis points rather than the 10. Okay, so now we're going to move on to part 2, where we look at the data coming out next week. Before we do that, I'm just going to go through our services with you. Yes, we provide a daily newsletter. That's just going to give you sort of current global news that's coming out it's just come out. Maybe overnight, depends where you are in the world. But you know, it's just we filter all of that news so you don't have to. And we do cover all the asset classes, financial, commodity, and even digital. And then of course we've got our great academy where we offer one-day workshops, one-week courses, and our very comprehensive masterclasses. One of those is accredited, another one is flexi, so that you can come and go as you need to depending on your other commitments. And a couple of them, a couple of the courses also include a free trading challenge. Then we offer trader mentoring. So, again, this is just to help you get to the next level if you're already trading. Maybe you're struggling to do that. I can look at what you're doing and make suggestions and help you to improve. We consult to companies, that's for hedging on FX and commodity exposure. And then, of course, education. So we provide educational content to individuals, exchanges and brokers. And as just mentioned, if you're looking for that funded account, maybe you feel that you're undercapitalized or you don't actually want to risk your capital, then you can go direct to the challenge if you've already got some experience. If not, then come and do one of our courses first and we will help to prepare you for that. Any questions, then you can reach out to us at info@symaxfintech.com, or if you'd like to ask me any specific questions, it's chris.tubby@symax-int.com.